Alrighty. Okay. Hello, everyone. Welcome back to SFC's Food for Thought series. For those of you who are just seeing SFC for the first time, we are an advocacy group made by students and young professionals for students and young professionals who believe that Canada can have a strong future in resources, the economy, and the environment. Please connect with us on Instagram, Facebook, and LinkedIn at Students for Canada if you want to learn more about what we do. Today, we are hosting Chris Redgate from RBC to discuss ESGs and investments in Canada. Chris is a managing director in the Global Energy Investment Banking Group based in Calgary and has been with RBC for over a decade. Chris has coverage responsibilities for a broad range of domestic oil and gas producers. Recent experience includes co-leading Tamarack's $200 million offering of sustainability-linked notes, advising Waterous Energy on its $800 million acquisition of the Tucker Oil Sands project, leading Enerplus's $132 million bought equity offering in January 2021, and acting as a financial advisor to Cenovus on its $10.2 billion acquisition of Husky in October 2020. Prior to joining RBC, Chris worked in Toronto for the investment banking group of a Canadian bank-owned dealer. Before pursuing his MBA, Chris worked for Colt Engineering as a mechanical engineer on the Talisman / Colt Prime Alliance. Chris holds a Master of Business Administration from the Rotman School of Management, University of Toronto, and is a CFA charter holder. Before I hand the floor over to Chris, please note that attendees are welcome to ask questions throughout the presentation using the Q&A box, which we will address at the end of the session. I will now share the spotlight with our guest. Welcome, Chris.
So, as mentioned, I have been with RBC for a little over 11 years. I sit in the global energy team and spend all of my time with domestic oil and gas producers. It's obviously been a pretty volatile number of years with numerous headwinds and tailwinds impacting the sector. Today, I'll provide a few thoughts around the energy sector, the backdrop, the outlook for Canadian energy, as well as ESG and energy transition. Um, Energy remains a true core focus for RBC. This means continued focus on traditional energy as well as an increasing focus on energy transition. Our organization has taken an active role in public policy through thought leadership, making the case for the energy sector publicly as well as to governments and regulators. In the top right of slide two, the quote that Canada's energy sector is integral to our economics and social fiber. It does drive jobs, fund social programs. A healthy energy sector is also the greatest opportunity for Canada to reduce emissions. We and the most senior leaders of our organization are certainly very front-footed with this message, and believe that it's really important for our country, for our citizens. We are a strong supporter of the energy sector and can continue to have one of the largest energy investment banking platforms as well as energy loan books. On page three, wouldn't be an investment banking presentation without a quick commercial. We have been fortunate to be involved in a number of M&A transactions as well as capital markets transactions over the last couple of years on both sides of the border. I think what we'd highlight here is that the energy sector has been extremely active. There's a lot of attention on the sector. We've seen a lot of consolidation activity and increasing interest from both debt and equity investors. On page four, just a quick look at the commodity backdrop. A key driver for some of the activity in our space has been commodity prices. There's obviously been a pretty significant recovery over the course of the last year. The sector's certainly been a lot more fun, a lot more investable, and with oil in the 90s versus oil in the 30s, a lot more opportunities and different types of conversations that we're having today. RBC had been one of the most bullish banks in terms of commodity price outlook going back to October 2020 when oil was in the 30s. Have a very constructive view of the outlook today. Our commodity strategist Mike Tran really laying out 3 steps for a constructive energy cycle that we're starting to see. The first 2 steps really a reduction in crude storage and a reduction in OPEC spare capacity. If you look in the bottom right of this chart, you can see where U.S. crude stocks sit today, meaningfully below where they were in 2020, meaningfully below where they have been over the last 5 years. The last step, really a call on U.S. shale. U.S. shale growth was, certainly hindering commodity prices and largely responsible for the fall in oil price that we saw But at this point, we actually see U.S. shale being a bit of a limiter in terms of an overheating market, and look for that production to help limit the move in WTI as we head through 2022. This is really the definition of a super cycle, where you have um, demand strengthening alongside supply tightness. We've saw WTI touch through $100 today. I do expect that we'll see WTI through $100 through much of 2022 and 2023. On page 5, I think everybody recognizes that we're going to have strong prices in the near term, but a lot of questions around what the demand for oil and what that picture looks like in the medium to long term. Demand for energy continues to grow, and when we look globally under a range of scenarios, demand for energy is going to continue to grow rapidly over the next few decades. In any realistic scenario, oil and natural gas demand will continue to be very strong for a number of decades to come. We think that affordable and reliable energy is the key to standard of living, the standard of living that many of us enjoy in Canada, and oil and gas will remain pretty important in maintaining affordable and reliable energy. On the right side of the page, um, a number of potential scenarios for oil demand that could play out. Different organizations putting out different scenarios. In almost all of those scenarios, oil demand continues to grow through the next decade, if not through 2050. I think this leads us in our team to be pretty optimistic about the place for Canadian energy and the opportunities for Canadian energy, not just in the near term, but for decades to come. On page 6, a look at the energy outperformance. It's been pretty dramatic on both sides of the border. Energy is was the number one performing sector in 2021, is by a wide margin the number one performing sector in 2022. This is obviously on the back of a pretty constructive price environment, constructive outlook, combined with really lean businesses that are generating significant free cash flow and returning a lot of that significant free cash flow back to investors. On the left side of the page, you can see the line in the middle. That's the TSX Energy Index, dramatically outperforming the broader TSX Composite. And then the dark blue line is the XEG, really a focus on the oil and gas producers, up 123% since the start of 2021. Very dramatic outperformance that has really drawn investors back to the space. It was easy to ignore energy or to hide in large cap names through the course of 2020. If you are hiding in large cap names or avoiding energy, underweight energy in 2021 and 2022, you've dramatically underperformed. On page 7, just looking at the performance more on a name by name basis, and this is since the trough of 2020, really the lows in March of 2020. We've seen a very dramatic increase in capitalization, the sector up nearly 5 times. Many of the names in this page were not investable in 2020 or even the first half of 2021, and today are basically must-own names that are sitting in the TSX Composite that investors effectively have to pay attention to. Two areas that are getting a lot of attention and are often spoken about in the same sentences are ESG or sustainable finance and energy transition. While they are often talked about together, they are separate topics. There's a wide range of investing strategies that would fall under sustainable finance, and people often think about a couple of things when you talk about ESG. One would be exclusionary investing, investors that won't invest in particular sectors, or sustainability themed investing, investors that would like to invest in a specific type of company in green projects. But what we're seeing is a significant amount of capital that's sitting under ESG integration, where investors are really integrating ESG with the company and financial analysis that they have traditionally done. I think there's a couple of different ways to view ESG. We think about ESG as transparency and reporting, and really an opportunity for Canadian energy to benchmark extremely well relative to global peers and to highlight a lot of the great work that they were already doing. On page 9, when most people hear ESG, particularly in our industry, we think about the E. The S and the G have become increasingly important. With respect to the S, really top of mind for clients is the impact that they have on the communities that they operate in, as well as diversity inclusion within their workforce. With respect to governance, much more focus on corporate culture, risk management, executive compensation, as well as inclusion at the board level. We do spend a lot more time and have spent a lot more time over the last 12 or 24 months talking to clients about ESG, thinking about ESG positioning, ESG reporting, and ESG scoring that has become much more impactful both in terms of debt and equity, as well as bank capital, but much more influence on ESG or from ESG rankings than we'd seen through the first 8 or 9 years of my time with the bank. On page 10, thinking about the energy transition, again, often spoken about alongside ESG, but very different. The energy transition is underway. It's going to involve a changing makeup of our energy supply, as well as decarbonization of existing energy and existing sectors. This transition is going to be very costly. We've got a number of different predictions in terms of what the energy transition could cost. We think that it's somewhere between 100 and 150 trillion dollars over the next 30 years, and for Canada alone, 2 to 3 trillion dollars. I think the key here is that we view this as complementary to our traditional energy business in a couple of ways. One, as we spoke about, the world is going to need more energy, and we're looking at all forms of energy, traditional energy, as well as new energies, renewables that will make up a larger portion of the energy mix. And then also as we think about decarbonizing existing sectors, oil and gas is going to be a significant component of Canada's decarbonization story. It's also probably the most near term and commercially viable opportunity to decarbonize the Canadian emissions is focusing on oil and gas, focusing on the oil sands, and we see numerous opportunities for oil and gas clients to play a pretty significant role in the energy transition and decarbonizing the Canadian oil and gas business. We'll just touch on two examples in the last 2 pages here of recent transactions. One that would fall under the category of ESG. There was a $200 million senior unsecured offering. This was a high yield offering for Tamarack Valley that we co-led. This was the first sustainability linked bond for an oil and gas producer of any size in North America. They really focused on two KPIs. The first, GHG emissions intensity, where they're looking to reduce scope 1 and 2 emissions by 39% by the end of 2025, a very ambitious goal. And the second, to increase Indigenous representation in their workforce to 6% by the end of 2025. We do think that there's going to be more sustainability linked activity, both sustainability linked credit facilities that the banks are providing and sustainability linked bonds that institutional investors are purchasing. Tamarack is a great example of a company that is focused on running a profitable business while spending a lot of time and attention on the environment and the environmental impact in the areas that they operate, as well as the communities that they operate in, and then a lot of focus on diversity and inclusion within their workforce. On page 12, Queetno was listed on the TSX earlier this year. The company is backed by Pat Carlson, who founded 7 Generations. It's a very unique business model, and I think that this would fall under the category of energy transition, a unique business model with an upstream asset combined with a power asset or energy transition business. This includes gas-fired power projects with carbon capture as well as renewable projects. Just that third bullet on the page in terms of Queetno's mission, really to build a profitable energy business, providing clean, reliable, dispatchable, low-cost energy. We are looking forward to watching the Kuitno story play out in the public markets and expect to see more of these combined businesses and unique energy business or unique energy transition businesses enter the public markets over the coming years.